on that spread chart, where if you plot each month's close, there was a clear multi-point ceiling that kept stopping all the rallies in silver versus gold. We closed above, we dropped back to the rising 3-month average on silver, a level it has not seen since the first half of last year. Sort of return to a rising average that is now acted like support. Sometimes you have to return to the mean, 3-month average isn't super long term, but it returned there. M2, and I haven't done it, but a lot of people have. You come up with several $100s just to match the 1980 high or the 2011 high when you factor in the decay in the money unit, the real buying power, the quantification of the money supply. An ounce of silver and an ounce of gold, and express it as a percent. It's the same study, except it's upside down version of a ratio chart. Okay, but you plot that. And like, for instance, we'll plot, well, we're to close each month, silver price into an ounce of gold. And you plot.
Greetings and welcome to our Wealthy On show. My name is Trey Reich, and we are here today with Michael Oliver, the proprietor and publisher of the Momentum Structural Analysis Report. Having been in this business for 4 decades, I can safely say that Michael's work is the most unique, interesting, and truly thought-provoking approach to technical analysis that I've ever read. And I encourage Wealthy On viewers with a deep interest in markets and how they function to give Michael's work a look-see. It's not cheap, I would say, but I believe it's well worth it. So for those who are serious about the trade, I send you in Michael's direction, and I'm sure he'd be happy to share some models of what he does. Boiling things down, Michael's analysis looks past short-term price analysis, which most technical analysis is obsessed with, and focuses on trends in long-term momentum. And I want to start our conversation today by looking back on the Wealthy On SCP Silver Conference, which we held on October 23rd at the Shangri-La Hotel in Toronto. Michael was one of the 2 lunchtime keynote speakers, and I need to set the stage for what was going on at the time of the conference, especially in silver markets, since it was a silver conference. But in August last year, silver was fairly steady at $38 for most of the month, and then started a nice advance, which ended up peaking on 10/17, 6 days before the conference, at 54.50. And especially given the amount of attention that the number 50 gets in all analysis of silver over the past decade, that was a pretty key level to break through a week before the conference. By the morning of the conference, silver had backed off to 48.50. And I will tell you that without question, the background overwhelming mood at the conference was silver had peaked and we missed it by a week. So that was the situation. And up to the stage walks Michael and very calmly presents his case that silver was not peaking. And in fact, he used the word explode. And I think he used the word explode 2 or 3 times during the presentation. And I remember thinking after hearing Michael speak, if there was one thing he was not short of, it was confidence. So as it turns out, he was dead right. In fact, eerily so. So I thought we would start with Wealthy On viewers to get an insight into how Michael works. Why were you so confident at that time?
The momentum trend, first of all, the price trend was obviously up as well. Okay. And we were challenging and finally nipped out those $50, what I call idiot highs, because they lasted for a half a century, $50, $4, et cetera, back and forth, confined like no other market on the planet almost. Gold wasn't confined during 50 years, neither was copper. Okay. Anyway, so at the time of that conference, $48, what are we now? We're trading right now as we speak, 76. So, terrible. Okay. Percent-wise, it's a huge gain. Yes, we're well off the high we just saw last month. But at that time, a couple things had already happened. One, we look at the trend of silver and gold in long-term momentum metrics. Like, for example, we measure the monthly price action of silver gold in relation to, let's say, a 3-year average or a 36 or a 3-quarter average. These are fairly long-term yardsticks. And we don't just overlay the average. That's not meaningful. Sometimes you can cross those averages and it's who cares. Okay.
This segment establishes Michael's credibility. When everyone at Toronto conference thought silver peaked at $54.50, backed off to $48.50, Michael boldly predicted explosion, and within months, silver hit $121, validating his confidence. The $50 idiot highs phrase captures frustration. Silver artificially confined in 4 to 50 range for half-century, while gold and copper moved freely. Why? Manipulation, concentrated shorts, whatever, but the confinement was obvious and ending. Michael's momentum structure showed breakout before price confirmed it. This is his edge. The current $76 level, well off $121 high, is what scares people now. Same fear as October conference when $48.50 felt like we missed it. Michael's message then and now: you haven't missed it, the explosion is just beginning. His confidence comes from structure. 10-year breakouts don't end in 2 months, they run for quarters. The dead right, eerily so confirmation means trust the structure again now as midpoint stumble completes and March resumption approaches.
It's when you plot the bars of price in their relationship to a given moving average. Like, is it above it or below it? Okay, and if so, what's the high of the month, low of the month, close of the month in relation to that given moving average? And those averages change, of course, every month on a 36-month, every quarter on a 3-quarter average. But anyway, you get a different chart when you plot momentum in bar chart form against certain long-term averages. And you see trend structures, the kind of things that an average price chart guy would, like, he'd draw a line across a couple highs and say, oh, we broke out over that line. Or a floor that you've used 2-3 times and you break below it, therefore it's all over, it's going down, that kind of thing. We do it with momentum. Almost always when there's a trend shift, even short-term, intermediate or long-term, momentum usually will break its structure and indicate the new direction prior to price smacking you in the face and saying, oops, I'm going down or I'm going up. Okay. So it's a good leading indicator, and you can anticipate trend changes, especially when you see on momentum a structure that just is so clear and used so many times as resistance or as support. And usually they don't last forever. I mean, you can only use a certain level so many times, and finally, if you hit it too many times, you go through. Okay. That's true with momentum. Anyway, at that point in time, silver on our long-term momentum metrics was already fully positive. In fact, one of our primary entry points was before that, was back in, if you recall, silver was capped in a range with a high above 35 in late 24 and a high above 35 again in March of 25. Confined for, there was like a year there where it twisted and turned at that level and to the downside, a congestion zone, but very wide. The third time that it came back up toward that 34, 35 level was back in June of last year. Silver still in the mid 30s, still in that range, but momentum said, you're breaking out. Price had not yet broken out. That would have required getting up to 35.50 to blow out those 2 prior highs on the price chart. But as it approached 35, that third time, our momentum broke out and we said, okay, acceleration phase for silver now commencing. Meaning, rather than this 2 steps forward, 1 step back process, it's going to be like 5 steps forward, 1 step back. Okay. And boom. Later in the year, we're at the $50 level plus. Okay. Challenging the old idiot highs.
This is Michael's key edge. Momentum structure breaks out before price, giving early entry signal. In June 2025, silver was still stuck in mid-30s range, same level that capped it for a year. Traditional price analysis said still confined, need 35.50 breakout to confirm. But Michael's momentum metrics broke out at that third test of resistance, signaling acceleration phase commencing. The shift from 2 steps forward, 1 step back, consolidation, to 5 steps forward, 1 step back, acceleration, means pace changes dramatically. Moves become explosive, not grinding. This June signal, 5+ months before October conference, is why Michael was confident in October. Momentum had already confirmed breakout. Price just hadn't caught up yet. The boom to $50 later in year validated the early signal. Current situation identical. Momentum structure, 10-year versus gold breakout November. Says acceleration continuing despite 121 to 76 price drop. Just like June gave early signal before 50+ move, November breakout signals move to $300 to $500 despite current scary price action.
But then something else happened, and that was in November, a month after our conference in Toronto. At that point in time, nothing had changed on the silver price or long-term momentum positives. They were positive already, no big deal. But why is it all of a sudden, after the November close, which I think was in the 70s or something like that, silver broke out versus gold, where when you plot the spread chart relationship between an ounce of silver into an ounce of gold, you go back 50 years, you can do that. You'll find that back in the 1980 bull surge in silver, silver was 6.5%, divide an ounce of silver, an ounce of gold, of the price of gold. Okay, keep that in mind. And then it dropped back down. And then in that same 50-year price range, in the second surge in that range, which peaked in 2011 at $50, silver versus gold reached up to 3.1%. Okay. Early last year, silver was at 1% of the price of gold. I mean, you think it's going to free? Okay. Anyway, so during the year last year, as we turned up, but especially after that at that November close, when we plotted that chart, you blew through a ceiling on that spread chart, where if you plot each month's close, there was a clear multi-point ceiling that kept stopping all the rallies in silver versus gold. We closed above it in November. And it was at that point we said, okay, the lid is really coming off now, because silver, whenever it does this versus gold, which it did in 79 prior to the explosion in 1980, and it did in late 2010 prior to its explosion again to 50, that spread broke out. And when that broke out, it told you the temper and tone is changing. So what happened since then? Well, we went up to $120. In 2 months, we went up to 120. Normally, when you see these spread breakouts of silver versus gold, like in that 79 period, in the summer of 79 or September 2010, it's over the next couple quarters that you see the consequence, not over 2 months. It's a massive chart breakout spanning a year or more of resistance, where silver just couldn't get up above this level. When you gush through that, you gush. And you usually gush for a couple quarters. And yes, in the middle of each of those surges, there is a shin kick that, oh gosh, it's all over. This one came a little sooner than we expected. We were frankly expecting a midpoint stumble.
The November silver versus gold breakout is the master key to understanding current situation. 1. Silver at 1% of gold early 2025 was absurd undervaluation. Historically, it's been 3.1% 2011 to 6.5% 1980 during bull moves. 2. The 10-year ceiling on this ratio meant silver could not outperform gold despite both rising. Silver was being suppressed relative to gold. 3. November close blew through this ceiling, lid really coming off, signaling silver would now outpace gold dramatically. 4. The 1979 and 2010 parallels are precise. Both times, silver broke out versus gold on this spread chart, then exploded, 1980 to $50, 2011 to $50. 5. Couple quarters timeline is key. 38 to 120s in 2 months was just first half. Normal pattern is couple quarters, 6 months. Total, we're at month 3 to 4 now with midpoint stumble. March resumption, 5 days away, begins second half of couple quarters surge. The gush language captures it. This isn't grinding higher, it's explosive move spanning quarters, not months. 7. A massive chart breakout spanning year-plus resistance doesn't resolve in 2 months. It resolves over quarters, meaning 300-500 zone target is couple quarters away. Spring-summer 2026, not distant future.
Late this month or early March. Instead of being like in the third month of the 6-month or so surge, it occurred at the end of the second month, earlier than we expected. So we were wrong in that regard. And it was deeper than we expected. But frankly, when we look at the depth of that sell-off, which got down to 71, 72, on Monday, first day of this month. So we had like a day and a half collapse, really. It was all a day and a half, the whole drop, a day and a half. We dropped back to the rising 3-month average on silver, a level it has not seen since the first half of last year. So to return to a rising average that is now acted like support. Sometimes you have to return to the mean, 3-month average isn't super long term, but it returned there and it tested it again today. So anyway, we view the pullback as being a very sharp but non-event in terms of changing our outlook. We still think silver is in a rampage. This is what you would call the midpoint stumble. And what we expect this month to see is silver firm again in February. Probably not see a new high this month. In other words, the January high stands, okay? True for gold and silver. But we see a firming action such that by the end of the month, we're well back up off this low and somewhat approaching the January high. It's in March that I would expect that if after we see that stability action this month, that you then resume. And March says, okay, game on again. And then, again, if we're correct in our analysis, and we have multiple reasons for coming up with this observation of the 6-month surge, it's not just that one thing, you could see silver reach into the several $100s.
This is the tactical roadmap for next 5+ days. 1. February, this month, ending in 5 days from recording, is firming action. Silver working back up from 71.72 low toward $121 January high. Not expecting new high in February, but approaching it means potentially $100 to $110 by month end. 2. Stability action means no more scary drops, no new lows, just grinding recovery proving stumble is over. 3. March, starting in 5 days, is when resume, the second leg up begins, game on again launching toward $300, $500 several hundred zone. 4. The conditionality, if after we see stability, is met if silver firms as expected. Chart will show low 71.72s early February, recovery through mid-February, approaching 100 plus by late February, then breakout early March. 5. Achieved by summer, from earlier clip, means March-June timeframe to reach 300 to 500 target. That's 3 to 4 months of explosive upside starting in 5 days. 6. The title 5 days to act is literal. If you don't have silver yet or want to add, you have until March resumption starts. Once game on again triggers, the move could be too fast to chase, like $38 to $120 in 2 months was too fast for late buyers. 7. 1 ounce silver to a house becomes reality if summer brings $300 to $500 as projected. At those levels with dollar collapsing, an ounce's purchasing power could be massive.
Does your momentum calculation, is it some sort of complicated mathematical formula that you developed, or is it something that's just simple comparison of
you've got a moving average. In our case, we use averages. A lot of people don't, like a 3/4 average. A lot of people use 200 days, which is about the same duration. We lose a 3-year average and sometimes a 36-month average, which is a monthly change in a 3-year average. Okay, 3-year average only adjusts once a year, for example. Boom, the new average. Okay, applies all year. And you plot the bars, whether they're above it or below it. So it's pretty simple, really. Okay. You come up with your average, and then you plot this month's bar in its proximity above or below that average. Sometimes we'll plot it on an arithmetic scale, like how many dollars above or below. And sometimes we'll do a percent scale, how much percent above or below. But it's not really difficult. It's just, and then we also use different averages. So we want to see, for example, if you break a trend on an intermediate type metric, let's say a 3-month average, which is sort of intermediate. In other words, when you break it, it may only be worth a 5-month move or 6-month move, not a multi-year move. So we like to look at that and know, well, what's the context here? If we just broke something that's short-term or intermediate, does it really alter the longer-term trend? And if it does, then, oh, that's important. But if it doesn't, if it's just a correction within a long-term trend, we note that. And we might tell our subscribers, yeah, you just broke something, but it's intermediate or short-term. So if you're concerned about what happens the next 3 weeks, then, be concerned. But if you don't, then don't. Okay. Because the big picture still says it's okay. So it's the time scales also matter. What's your context? But it's simple to do. Yeah.
The last term is spreads. Yeah. Do we need to talk about that or not?
Well, a lot of people do the ratio of silver to gold.
Okay.
The multiples. We just do it a different way. We divide an ounce of silver and an ounce of gold and express it as a percent. It's the same study, except it's upside down version of a ratio chart. Okay. But you plot that. And like, for instance, we'll plot, where do close each month? Silver price into an ounce of gold. And you plot it on a chart, it's X percent. And then you plot the next month and and after a while you get a spread chart building structures maybe, or trend lines. In the case of silver recently, it had like a 10-year wide structure where it couldn't get above this shallow level versus gold. And the close of November it did. Okay. A fresh breakout over a 10-year wide structure does not end 2 months later. Okay, that's the message. You don't break out over a 10-year wide base and expect to see the top in 2 months. Mm-hmm. A pullback, yeah, but it just began, in other words. So you look at the context as well. Now, if that structure were only something that went back 3 months, then maybe, yeah. But you had a 10-year wide structure. So when you look at that, you realize this is big. This just changed. And you mentioned another issue, gold in relation to the S&P. That also broke out. Silver versus the S&P, gold and silver miners versus the S&P, all had spread relationships to the S&P where you could plot a line going back to 2014. So 11-year wide, either slightly declining or flat. And they all broke through that relative performance structure in November, saying, hey, I'm now a better place to be than you are. And it just began. You don't have something that big and wide that breaks out over something that smacks you in the face and expect the high in 2 months. Okay, that's another message for the.
This is the structural argument destroying bear case. 1, 10-year wide base is massive. This isn't 3-month consolidation or 6-month triangle. It's decade of resistance. When such structures break, they signal major trend change lasting years, not months. 2, does not end 2 months later is emphatic. It's structurally impossible for decade breakout to resolve in 8 weeks. The minimum move is quarters, 6 to 12 months, likely years of new bull phase. 3, it just began, repeated twice for emphasis. We're at the start of new reality, not the end. The $121 peak was just first impulse, not final blow-off. 4, the confluence matters. Not just silver versus gold broke out. Also gold versus S&P, silver versus S&P, miners versus S&P. All these 11-year structures broke simultaneously in November, meaning entire precious metals complex is saying we're better placed to be than stocks after decade plus of underperformance. 5, when multiple decade-wide structures break in same month, November, it's paradigm shift, not random volatility. This is capital rotation from financial assets to real assets, from stocks to metals, from paper to tangible. 6, the context argument is killer. If someone says 121.76 drop means top, ask how long was the base that broke. If answer is 10 years, you can't call top in 2 months. Structurally impossible.
The longs right now. Mm-hmm. But yeah, it's simple. A spread is just a simple chart expressing the value of one to another. And it develops technicals, just like price chart guys like to look at, trend lines, ceilings, etc.
So this is a perfect, you probably answered it in circular fashion, but I think we'll now hit the $64,000 question, which is on everyone's mind, which is after last Friday and last Monday. And silver had a bit of a check back again this morning that apparently started in Asia.
Mm-hmm.
What has been the impact of Friday and Monday on your intermediate and long-term models for gold and silver, and why shouldn't people be scared to death?
Well, if you drop down to a more intermediate time scale, because again, I said quarterly and annual momentum, there's not any structure that's anywhere nearby to say, oh gosh, I broke it, it's over. Okay, it just doesn't
That's
exist.
the long term.
Okay, that's long term. Drop down to intermediate, and intermediate would be monthly, month to month versus a 3-month moving average. Okay, usually when you get trend swings on that metric, on the oscillators, you'll see they run for 4 to 6 months. Okay. That is if you break a structure. Now, this recent pullback, instead of breaking anything, it came down to an average, the 3-month average on gold and silver, that it hadn't seen for silver, for example, since before last summer. So all these months of rising silver, you never even condescended to pull back and touch your rapidly rising 3-month moving average, like the zero line on the oscillator. You hadn't even come down to it. So finally, we touched it early this month, the first day of this month, when we had a slight further follow through to the collapse last month. You touched the 3-month average almost precisely, and you rallied $20 off of it. Now you came back and retested today. It's not structurally important. It's just an interesting fact that you haven't even returned to a balance point, a zero line, the 3-month average. And it's likely we'll find support there. Gold did the same thing. Gold broke it by, I think, about $50 and immediately exploded. So that's what I think we just saw. And it was merely a return, even on intermediate stuff. It said, hey, this might be a place to buy. Now, when we shrink down to weekly and go to like a 3-week average, we blew a structure on weekly on Friday a week ago. And sure enough, instead of a nice sell-off, you had a huge sell-off. We've broken that same structure before on weeklies and only had a, so-so sell-off. This time it happened to be big. This week's high rallied back up to the 3-week average, which changed from last week, obviously, and bumped our head on it. So on the oscillator, you broke through the zero line, and this week you came back up and bumped it. So what had been prior lows, now, boom, you bumped it. You set that level. So next week, with a now falling 3-week average, if you get back above it, the weekly momentum, which had a stumble and broke a minor structure, you'll reassert yourself back above the structure saying, okay, game over, I'm back up again. And all it takes is getting back up into the upper 80s anytime next week on silver. We'll do that. So, but again, that's short term. So don't confuse it with an investment grade position.
Got it. So, in essence, nothing that happened in the past week has you too concerned. I have all these questions come to mind whenever I speak to you. Should anyone have been trying to sell a little silver and trade it at 121, or do you think that's counterproductive?
We were looking for a midpoint stumble in our couple quarter surge that we expected to have a couple quarters of massive surge. Back in 79, when that occurred, again within that old $50 range though, and in 2010-11 that occurred. About in the middle of that clock, one was a 5-month surge, one was a 7-month surge. About in the middle, there was a bad month. In the case of 79, it didn't actually close down, but you had a stumble that for about 6 weeks you could have gone sideways after you stumbled. Okay, so it didn't go anywhere. And in January 2011, you had a massive monthly reversal on a price chart where our price guys say, that's a key reversal month, it's over, okay? The next month, worked your way back up. And what happened on the other side, once you cleared that high, was more massive than what had happened up to that point. So it was a massive move interrupted by a midpoint stumble. We thought that likely would occur more likely, let's say, get into 3 months into the possible couple quarters. Instead, it happened after month 2. So we were a bit surprised by the quickness of it. No, we did not call it. We were anticipating such an event probably late February, early March. But now the game's changed. They moved it up. Okay, fine. We still think that's probably your midpoint stumble. That's not the end of this move. Again, we've got too many metrics that are massive in years. Gold versus S&P, silver versus gold. All these things just occurred in November. You don't break out of a decade-wide base and go for 2 months and say, oh, that was it.
Do you ever try to trade stumbles?
Oh, yeah. But in this case, I think this is an investment grade move in the monetary metals that you shouldn't trade.
Okay.
We've been saying all along that there have been many over the last year, 10 and 15% drops in silver that happened like overnight. Okay, now this was bigger, okay, admittedly, but they happened very quickly. Used to be they'd take several weeks to recoup or a month or two. Now they're occurring rapidly. Look at the October stumble we had, for example. There was a sharp sell-off in October that I think was like a 15 or more percent drop. It took a couple of weeks to get out above that. So I don't think this stumble is going to last very long. And the problem with exiting prematurely, even in a thing like this, is when do you get back in? Do you get back in? When do you get back in? And is it better than where you got out? Or if you don't get back in fully, what's on the other side of this is highly likely to be far more gain for you, had you not wiggled, than what has already occurred by our assessments. We think what's on the other side of this is far greater than what's already occurred. So you have to think about it as an investor. Are you in this for the jiggles, even the sharp ones, to avoid? Are you in this on an investment grade? And we're arguing you don't have to wait for years on this either. Highly likely that much of what we're going to get this year will be achieved by summer.
This is critical psychology for holders tempted to sell. 1. Michael trades other markets, but says this move is investment grade, meaning don't trade it, just hold through volatility. Why? Because getting back in is harder than suffering drawdown. 2. The timing trap. If you sold at $121 peak, do you buy back at $76 current? Most won't. They'll wait for confirmation at 90 to 100, missing the bottom. Or worse, they never get back in fully and miss the 300 to 500 move. 3. What's on the other side is far greater than what's already occurred. This is the key. $38 to $121 was just first half, couple months. Second half, March through summer, to $300 to $500 is triple the gain of first half. So if you trade it out to avoid 121 to 76 pain, 37% drawdown, you're risking missing 300 to 400% gain on other side. 4. The achieved by summer timeline is urgent. This isn't multi-year wait. March to summer is 3 to 4 months to potentially reach several hundred zone. That's why 5 days matters. March launch starts the sprint to finish. By investment grade means treat this like buying rental property or starting business. You commit capital, ride through volatility, reap massive gains years later. Except this investment compresses years of gains into months. The jiggles question exposes trader mentality. If you're trying to avoid 10 to 15% swings, you'll miss 500% moves. Have to choose: trader, small gains, small losses, or investor, massive gains, temporary drawdowns.
Now, it's always unfair to ask for targets, but on just very briefly, do you have a target and a time frame, or do you have either? Can you have both? What's your target or time frame on gold?
Okay, I'm going to give you two views of reality that are simply price. Okay, if you get a price chart of silver monthly, go back to 75, you'll see that it lived in this half century zone of reality. $50 to 4, $50 to 4. So it's about a $45 range. Okay, you add 45 to 50, the arithmetic swing objective of a box like that on a price chart. You take the distance of it and you add it to the top. It says target 95, maybe $100. Okay, what happened back then a couple months ago? You stumbled in the mid 90s. It was repeated selling, 93, 95. Okay, guys saying, hey, we reached our objective on orthodox methodology. If you take a logarithmic or ratio scale chart of silver, same time period, you'll see that that range from 4 to 50 was like a tenfold dimension. If you bought the bottom of that range and went to the top, it's tenfold from where you bought it to the top. And it went back down, up and down, for 50 years. Okay. Tenfold on top of 50 is what?
Okay. Gotcha.
Okay, 500. Okay, now you want to take a gold chart, do the same thing back to 75. It's had bull moves that blow out the prior high. On a ratio scale chart of gold, not arithmetic, but ratio, you'll see that both of the prior bull markets, the 1980 peak, the 2011 peak, were 8-fold gains, bear low to bull high. Silver was still capped at $50, but gold wasn't capped at each peak. It was an 8-fold gain from bear low to bull high. If we have another 8-fold gain, which is merely matching the dimensions of the prior two bull markets, 1980 peak, 2011 peak, you'll go to $8,500.
That's based on the 1050 in December 15.
Yeah, I've put it in a lot of reports, but that's merely replicating an old reality you've done twice in gold. Eightfold. Big deal. Right. You do it again. Look at the conditions out there, the factors in play, the bond market problems, the Forex problems, commodities asserting themselves again, a new commodity bull, inflation, as many people like to define it. Gold's going to top with a 5-fold gain. Okay. So even if we just match that, and by the way, we coming up with that number months and months ago, JP Morgan just came out with the same number, 8,000 to 8,500. We find that curious. But even that's not our target. But in the case of silver, if you do the ratio scale of its dimension, you come up with 500. And if you factor in M2, and I haven't done it, but a lot of people have, you come up with several $100s just to match the 1980 high or the 2011 high when you factor in the decay in the money unit, the real buying power, the quantification of the money supply. Silver, to get back to those realities, would be well in the several hundreds.
The math is simple and devastating. 1, silver's 50-year range, $450 was tenfold. Buy at bottom $4, sell at top $50 equals 10x gain. 2, tenfold on top of 50s, the new bottom post-breakout equals $500 target. This isn't hopium, it's matching the dimension of the prior range. 3, gold precedent confirms pattern. Both 1980 and 2011 peaks were 8-fold gains from bear lows. Replicating that again equals $18,500 gold. Michael calculated this months and months ago. JP Morgan just published same target. Independent confirmation. 4, M2 adjustment makes it more bullish. Due to money supply expansion, debasement, silver needs several hundreds just to match the real purchasing power of 1980's $50 or 2011's $50s. So $500 isn't 10x gain in real terms. It's just catching up to prior peaks adjusted for currency debasement. 5. The arithmetic versus logarithmic distinction. Arithmetic, $45 range plus $50, $95 target measures dollar moves. Logarithmic tenfold measures percentage moves. In collapsing currency environment, percentage moves matter more. Tenfold is the pattern. 6. 1 ounce silver to a house. Thumbnail is conservative at $500. If dollar hyperinflates while silver goes to several hundreds, purchasing power of 1 ounce could be massive relative to depreciated dollar assets.
So we keep coming up with numbers that say, hey, and we looked at copper and lead back in the 2005 and 2007 for lead. They broke out of a similar range, and when they broke out, literally in a couple of quarters, they quadrupled in price on their own without help from other markets. They went into a new reality. How come silver was caught in that reality for 50 years? Something smells there, okay? Well, it's saying no more. Okay? And it has yet to achieve anything remotely close to what even copper and lead did or to what gold has done over the last 50 years. I think it's about to.
So we've sort of covered the upside in terms of confirmation. Are there prices for gold and silver that would concern you on the downside that might be signs or triggers of a failed move or an extended downdraft?
When we look at long-term momentum, we have no structures that are nearby.
Gotcha.
Therefore, it is highly unlikely, it's rare indeed to ever have a market collapse that is not pre-triggered or very closely triggered off of a high. One of the first things I caught before I set up MSA was catching the crash in 87. I didn't catch it in a big way. I bought puts for myself and my futures clients. I was a broker then. Why? Because quarterly momentum of the S&P had built a 3-year wide floor at its zero line on the 3-quarter average. So in August, September of 1987, it was making new price highs. Oh boy, it looks great, okay? And you oozed off that high in September. And in the first week of October, the new quarter, you were down to that structure again. It wasn't going to hold the fourth time. It didn't. We crashed within 2 weeks, 35% literally in a couple of weeks, which is the definition of a crash, that dimension. Quarterly momentum told you. And when that occurred on the price chart, you were hardly off the highs compared to where you went at the. There was a structure there that explained it. There's none now.
Interesting.
Therefore, on my methodology, a sharp break that doesn't break structure is merely a sharp break.
And when you say structure, just for viewers, you're talking about momentum structures,
momentum
price
structure.
structures.
A massive uptrend you can define clearly, or a flat floor. Neither exists anywhere near where we are.
All right, precious metal equities. Can you?
Yeah.
You could probably talk about them for an hour, but do you have a couple
They're
of
vastly
observations?
undervalued to gold. Okay. Now, the XAU index has been around since the 1980s, so we use it. It's the gold and silver miners index, Philadelphia Gold and Silver Miners Index. If you go back and look, where was XAU in relation to an ounce of gold? 1980s, 1990s, 2000, up through 2008. So for multiple decades, it oscillated in its relative value to gold at 25%, meaning if you divided XAU price into an ounce of gold, the median price of that multi-decade range was 25%. The bottom end of that range was 17 to 18% repeatedly. The upper end was 35%. So let's call 25% its normal value to gold for decades. In 2015, in the bear market in gold and the miners, it dropped to 4% of the price of gold. I mean, what do you think? Something that lived at 25% an ounce of gold went to 4, it's going to 0. That asset category, the miners, were off the page dirt cheap. For 11 years, they've bounced and been in a range with multiple lows since at 5% and multiple highs above 8. We got up above 8 last month. They snapped it back down by the end of the month, so you didn't break out above the range, but there is a perfect rectangular range spanning back to 2014 that the relative performance of miners is trying to break through. When you break through that ceiling, and I think we're going to, the persistence indicates it to us. You get back up above, let's say above 8.5% ever again, divide XAU, an ounce of gold, you're breaking out of that massive base at very cheap asset levels. In other words, if you respect gold and silver, why don't you respect the guys that get it out of the ground? They're essential to you having the metal, okay? And they're still at vastly underpriced levels historically.
The miners' case is compelling. 1. Historical norm for XAU versus gold was 25% for decades, 1980s, 2008. Miners currently at 5 to 8% range, meaning they're trading at 20-30% of historical valuation relative to gold. 2. The 2015 low at 4% was absurd, going to zero sentiment, off the page dirt cheap for 11 years. They've bounced but still massively undervalued. 3. If you respect gold silver, why don't you respect guys that get it out of ground? His philosophical argument. Miners are essential. Without them, no metal exists. Yet they trade as if worthless. The breakout setup, 2014-2026, rectangular range at 5 to 8%, trying to break above 8.5%. When this breaks, Michael expects 2026. It signals miners doubling relative to gold, from current 6 to 7% to 12 to 14%, halfway back to 25% historical norm. 5. If gold goes to $8,500, Michael's target, and miners double versus gold from 6%, XAU would go from 300 current to 1,000 plus, 12% of $8,500. That's 3x plus gain in miners versus 1.7x in gold. Leverage. 6. The during 2026 timeline means this year, same time frame as silver to 300 to 500s. So the 5-day urgency applies to miners too. Last chance to accumulate before breakout. 7. 1 ounce silver to a house could become 100 shares miner to a house if leverage plays out.